Good morning everyone and welcome to another RF Crypto video. Today I want to speak about the Federal Reserve increasing interest rates by 0.75%. So yesterday the Federal Reserve Bank met and they decided that they would increase the benchmark rate by 0.75% or 75 basis points. So if you're a person living in the US at the moment, you're probably worried about the economy, inflation, the stock market, and a lot about money feels pretty bad because everything is getting more expensive. However, there is some good news. The Fed is trying to take action to try and bring down inflation and get the economy back to normal. So bringing down inflation from the current 8.6% to 2%. The bad news is that the action it's taking isn't going to immediately make everything better. And in the short term, it actually might make things feel worse. It might not make everything worse, but it will definitely feel worse. Basically, getting inflation lower is usually painful because the Fed mainly has in its policy toolbox tools that make things even less affordable because these tools are geared towards cooling demand. If the Fed manages to cool demand, then there will be less price pressures, but cooling demand translates to essentially making things more expensive. To put it more plainly, the idea is to tamp down customer spending and slow down business expansion by increasing costs in other areas, or the cost of money, namely borrowing and loans. So the Fed is trying to get you for now to stop buying so much stuff. So it sounds counterintuitive. Economic growth is so low and they're trying to even lower it. So as I said before, the Fed on Wednesday raised interest rates by 0.75%, its biggest increase in 28 years since 1994. The Fed was initially expected to raise rates by 0.5%, but in May, the consumer price index, or the inflation rate, was very, very high, so it acted more aggressively than anticipated. And this is already the Fed's third interest rate hike for the year. The hope is that eventually the Fed's moves will bring down prices that people have definitely not noticed creeping up. And this isn't only in the US, but around the world as well, because as I said before in my previous videos, when the US sneezes, the whole world catches a cold. So this will have shorter term implications as well. Higher interest rates means consumers should expect the cost of their credit card debt, mortgages, and car loans, among other things that rely on debt, to go up. The cost of borrowing for businesses will increase because interest rates are now higher, and companies are likely to slow down on investments and hiring. The stock market has for weeks been reflecting some anxieties over the Fed as well, as higher interest rates cuts into valuations and profits. So all in all, rates have already gone up. We already are in a transition phase where the economy is slowing down, and it's evidenced by the decrease in the US economic growth rates, but the pieces are being put in place for the rebalancing of demand and supply, and this does not happen overnight, and it's usually a bumpy ride. So in order to achieve this, the Fed has three main tools. The first is forward guidance, as in communication, which means talking to the public and saying what its intentions are in terms of monetary policy. Basically, if the Fed says it's going to take control of the situation, the public believes it will. The second tool is raising the federal funds rate, or the interest rates that the Federal Reserve charges other banks, and this rate was increased by almost 1% or 0.75% on Wednesday. This trickles out across the economy and everything becomes more expensive to borrow. The third is balance sheet normalization, which the Fed is also undertaking. It is starting to unload some assets such as treasuries and mortgage-backed securities in order to remove some of the cash or excess cash in the markets, which should tighten financial conditions, but it will take time. So combined, these three tools are intended to deter spending and lead to less money sloshing around in the economy overall. There are, however, some effects to the economy and to the public. When the Fed tightens monetary policy, there is a direct effect on equity prices, long-term interest rates, corporate bond spreads, volatility, value of dollar, and a number of financial measures. Companies become more reluctant to invest and hire as credit becomes more expensive. The cost of equity increases and the environment becomes a lot more volatile. Declining markets have a negative impact on consumer moods, which also affects spending. So right now there's an intended slowing down or chilling effect across the economy, and there are hopes that this will not lead to a recession, though there are no guarantees. Obviously, the Fed is full of smart people, and they will know how much to increase interest rates in order to slow down the economy, but not so much as to lead the economy to a recession. However, the Fed is also walking on a tightrope in trying to get from an accommodative, easy money scenario where interest rates are low to conditions that are normalized and tightened without disrupting the economy too much. So remember that during the pandemic, a lot of money was injected into the markets due to the Fed lowering interest rates to nearly zero, as well as purchasing assets to pump up its balance sheet. So when the Fed purchases assets from the public, they inject money into the economy. And if the Fed were to not increase interest rates and get inflation expectations in check, the risk is that prices would continue to spiral upwards, with the inflation rate maybe going upwards of 10%. Workers will then ask for higher wages, companies will raise prices to pay those wages, and it becomes sort of a cycle whereby prices rise, wages rise, prices rise, wages rise, and we will have a runoff inflation scenario, which would lead to the inflation rate going to above 30-40%. And the central bank or the Fed's task is now to stop that from happening and trying to get inflation under control. So what this means for normal people, or you and I, is that going forward, it depends on who you are. If you're a saver, or you have money in the bank, or you have money in fixed deposits, then it's good for you because you're getting more interest in the money that you keep in the bank. But if you want to buy a house, if you want to take a loan from the bank to start a business, or if you want to get a car loan, then that's bad for you because now the cost of borrowing will become more expensive. So when, let's say you borrow $100,000 and the interest rates are 2%, it's not much. Your yearly interest is $2,000. But if it goes up to 4%, your yearly payments double to $4,000, which is very painful. And looking back in recent years, interest rates have been so low that the incentive to save was very low as well. And looking at credit cards as well, it's going to show up pretty quickly, and it will impact not just the things you buy in the future, but current balances as well. Usually, when the Federal Reserve raises interest rates, credit card rates also go up by the same amount within a billing cycle or two, or within a month or two. And generally, these individual hikes aren't enough to really rock anybody's world financially, but the danger is when you have a lot of them in the short period of time, and they can add up pretty quickly and they can be pretty impactful. And this is just because when the interest rates are very low, you are incentivized to take on more credit card debt because you can usually pay them off. However, if you have so much credit card debt and interest rates increase, your credit card interest rates will also increase within a month, and your repayment will become a lot more expensive. And this isn't going to be fun, and we are going through kind of a rough patch. Everything's expensive, and for a while, some things are going to be more expensive, and then eventually things will not be so expensive anymore. In the meantime, it's not going to be particularly nice. And there could be a recession on the way, no one knows, but it's a possibility. And one thing consumers can do to navigate the moment is to reduce spending. Maybe put off a trip, maybe save on petrol, maybe save here and there, and that is something that will put you in a better position going forward, because once things are normalized and things aren't so expensive, you will have savings to fall back on and you can live a pretty comfortable life. And by doing that, you can also do your part in contributing to reducing demand and helping the Federal Reserve achieve its aims. Also, if you have credit card debt, pay it now because it's going to get more expensive. And it's going to get more expensive pretty quickly. Knock out as much credit card debt as you can because credit card debt is expensive, and when the rates go up, it tends to become a lot more expensive a lot quicker, and a lot of people are caught off guard, and they usually can make repayments and they fall into a debt trap. So in the short term, it's going to be painful, but in the long term, it's going to normalize, because the long-term situation the Fed feels that is much more important for them is to go ahead and reduce pressures in the economy so that we have a healthier, stable economy going forward. And that will set the economy up for better long-term growth. So we have to see how this pans out. We have to see if the inflation rate reduces through consumer spending reduction. Also, what will help a lot is if the conflict in Eastern Europe ends so that the price of oil can become normalized, because the price of oil being so high has also pushed the inflation rate up. If the price of oil goes up, the price of transport goes up. So you're paying more for petrol and you're paying more for virtually everything you buy in the supermarket, because those things need to be shipped or transported by land, and that uses petrol, which is made from oil. So it is a matter of waiting, it is a matter of riding out this rough wave, but we have faced recessions before, and we have faced tough times before, and as someone that I've seen on the internet says, tough times never last, only tough people do. That's it for today's video. Thank you very much for watching. If you enjoyed the video, please leave a like, hit the subscribe button, and share this video with your family and friends. Invest wisely, and cheers.